Hey everyone, welcome back to Elite, the High Finance podcast with Kaushik Ravi, where each time we're joined by incredible guests, thought leaders, and speakers in the private equity, hedge fund, venture capital, AI, and finance industry to really talk in depth about their experience in the industry. The rationale here is, right, there's very few high quality finance podcasts that really take you behind the scenes of these elite careers and professionals and really give insights and advice on ways to get better at your day to day as a professional, ways to grow in the industry, ways to become elite, and also ways to enter this different spaces. So we've had on amazing speakers already, and we have yet another one with Tim today. I'm super excited. Past speakers, right, associates, VPs to partners and C-suite across all levels, fund sizes, and sort of top funds in the world, and even seasoned investors, right, like Mark Cuban, Anthony Scaramucci, bunch of those folks. This podcast and platform is really for current professionals at various stages, right? Analyst, associate, VP, partner, etc., as well as aspiring professionals, right? Whether you're an MBA student, a college student, or just a professional who wants to break into the high finance space. So make sure to share it with your friends, colleagues, and support the podcast. Quickly on Onefinnet, One Financial Network. The founder here, it's the premier finance and AI and finance platform and the largest finance network in the world, actually. So used by top firms and top professionals. So on the firm side, one on the professional sides across our various sub platforms. So we have an AI and finance platform, a capital raising platform, a hiring platform, an M&A platform, and for professionals and students, training, coaching, networking, and all of the above. So without further ado, I'm super excited to introduce our speaker today, Tim Shu. He started his career at Goldman Sachs in investment banking and then has built his career in the private investing space, in the private equity secondaries industry. And then after several years of doing that, is now an equities investor at Balyasny, which is one of the top investment slash hedge funds in the world. So I've personally gotten to know Tim very well over the years, and he's just not only just an incredible professional and leader, but also a terrific mentor to the next generation. So that's why I'm super excited to have invited him and him accepting the invite and joining us here today. So Tim, thanks again for being here and kind of speaking to all the folks here on our platform. We'll kind of break this roughly into kind of four main sections, which will be, kind of your career background and a little bit about all the industries that you've kind of been in on the secondary side, as well as the hedge fund world. Then we'll kind of dive in actually into the secondaries and sort of that industry. I think obviously it's going through a kind of a monumental kind of growth in that space. And so I think it's creating a lot of jobs and it's also sort of creating a lot of interest. And so what's really helpful for people who are either in that space or looking to enter is to get it like a bird's eye view and a ground level view of kind of what's actually happening, what are the trends. And then we'll kind of shift to the public investing side, which is another industry that everyone wants to get into on the hedge fund side. So we'll kind of do that. And then we'll focus a lot around sort of how do you break into these careers and what are the different strategies and all of that. And then finally, we'll end with a lot of sort of questions on just ones that have come in from people who are listening on what they want to learn from professionals on this forum. So with that said, Tim, let's jump in. I'd love to start section one here, just a quick intro or just talk us through your career journey to date from Goldman Sachs in investment banking to the PE space and then eventually now to sort of the public side.
Yeah, thanks for having me, Kaushik. But For everyone here, I was born and raised in Taiwan for about 18 years. I came to New York about 10 years ago to study at NYU Stern. I had the fortune of interning at a small boutique investment bank called Rothschild during my junior year, covering the industrial sector. And ended up taking a full-time offer there after graduation. I worked there for about 7 to 8 months. It was a M&A focused job. It was super. It was People were super great. Transactions were very fascinating as well, but it was a bit homogeneous for me as a kind of a 21-year-old coming out of college. So I joined, Goldman after about 7 to 8 months of working at Rothschild, covering the same companies, but just with a broader aperture of kind of transaction tools across debt and equity financing, private advisory, et cetera. I worked there for about 2.5 years, representing a range of, private equity clients in the industrial space. I remember, representing 4 to 5 private equity transactions, all within the stretch of the same 6 months, and not being able to get a transaction done. And that was during late 2023 when M&A and IPO markets were effectively shut because rates were jacked up pretty high very fast. After seeing that, I did sort of an internal analysis. These, in my view, are businesses, industrial businesses that are good cash flowing businesses. But then the reason why they're not able to exit is because number one, large bid-ask spread kind of caused by the Fed rates hike, and number two, just simply because no one is trying to invest in an environment where there's so much rate uncertainty. Um, so I sort of realized that everyone's trying to go in private equity. Private equity has been a really hot space, but 2023 is when everyone took a pause and said, "Hey, private equity is actually an interest rate sensitive product and investment vehicle here. When you have no liquidity, you won't be able to exit anything." So private equity investors started panicking a lot. The LPs started panicking. They wanted their money back. You have 2 years of 2 to 3 years of lost years from 2020 to 2023. A lot of businesses got hit on a performance basis. And now you have this M&A and IPO market shut down and you can exit as a private equity investor. So I kind of saw that. And instead of going the traditional private equity route, I actually went into secondaries private equity, which is back then super under the radar strategy. But I saw this as a potential solution to private equity's liquidity issues because it's not just a 2 to 3 year problem. In my view, you've got the structural issue of everyone sitting on about globally sitting on about 4 trillion of dry powder, and 2 trillion of dry powder, and maybe got 4 trillion of unrealized assets. Adding that up to $6 trillion of private equity assets that you need to exit over the next 7 to 10 years. M&A and IPO markets alone, and the private markets won't be able to sufficiently absorb that. Plus you also have some ad hoc LP liquidity needs. So I joined a small secondaries firm called WCAP, and they're pioneering sort of in the space. They got started after the dot-com bubble to trade venture cap stakes, but now I've moved up the maturity level of businesses to trade growth equity and cash flowing mature businesses. I worked there for about 2.5 years. I learned a lot and kind of was a part of the explosion of secondaries from 2023 to 2025. The firm, as a result, got acquired twice. I really loved the firm, really loved the strategy as well, which I'm happy to talk more about. But then I saw this once in a generation opportunity to go and participate in the AI boom. And what I realized with the AI boom, this cycle around versus the internet boom back in the early 2000s is that all of the value is accruing to publicly traded companies that have a lot of capital. And in order for you to be at the bleeding edge, you have to be tracking these businesses. These are the Amazons, the Googles, the Microsofts of the world. Yes, they're private businesses, but majority of value is accruing to that. And I'm happy to talk more about that. So as a result of that, I became a public equity analyst at Corbett's Capital, which is a capital sleeve of Balyasny, covering exactly those companies that I just mentioned, the U.S. internet companies. But happy to talk more about any of those.
Awesome. Fascinating. I think you really kind of hit on the career trajectory and really following some of the market trends that are going on, right? With the sort of the desire for you to go from sort of just pure play M&A to get access to a lot of different products and larger deals from kind of the Rothschild to Goldman switch, and then effectively, noticing sort of the traditional private equity buyout volumes because of interest rates, and then going to the space that's actually really growing, which is the secondary space, and getting a lot of experience there because ultimately you're underwriting deals and the people making those deals and the funds that have those investments, and then tracking now, rightfully, and kind of thinking about that the public domain of AI is much larger, multiples larger than the private domain, which is still kind of catching up and kind of leveraging that trend. And I think that's a lesson learned for a lot of people who are listening, is sometimes, it's not always kind of like what's the next thing that everybody else does, but kind of where you see the market going and then being able to leverage that and through it to make it. So great job, Tim, to kind of kick us off here. I guess my one, just kind of diving in here. By the way, we're going to dive into both secondaries and the public side, so no worries, Tim. We'll get through those. But maybe just quickly on, a lot of people listening are already investors or they want to be kind of investors on either the private or public side. So maybe just talk a little bit about what are the differences in mindset between sort of looking at something from a private equity angle, which might be a little bit more long term, and there's kind of that liquidity holdup maybe, and then sort of an investor who's looking from a public angle. So what are the key differences and similarities for someone who might be coming from one or the other background, but also is interested in either space?
Yeah, happy to dive into that. Just in case there are sort of aspiring, professionals here who are currently students, I will kind of throw out an analogy here just to kind of just wrap the sentiment, because I think it's fairly true having worked in both the private side and the public side of things. Private equity and the private market is sort of like playing soccer. It's bit of a longer game. It's a fully team sport where you can go a little offense, but at the same time you have to defense, and maybe you score a goal, or two per game. That's sort of private equity, and I can go a little deeper into that. Whereas public equity side, it's generally split between long short, which is fast money versus long only. These public equity seats tend to be more like playing tennis or boxing, where you're supposed to be a domain expert in whatever you do and whatever you cover, and you're supposed to be nimble yourself and be be aggressive in going offensive or pulling back a little bit. And it's less of a team sport sort of dynamic. Um, and part of the reason why I moved over to the public side, and this has everything to do with personality and nothing to do with competence or anything like that or intelligence. There are plenty of smart people in private equity and in public equities alike. But private equity is sort of a seat where you need to truly believe in a select few businesses and really be committed to a few select businesses. Because if you think about it over the course of maybe your 10, 15-year career at a firm, you'll probably only do like 3 or 4 big deals, but then you have to follow those big deals for 4 to 5 years from initial transaction close to at the end packaging the business and selling it. You need to really have a deep understanding of that industry that you're in and have conviction that the value creation you're driving for that business will work. And no one's going to tell you if it will work or not. You have to then draft up the business plan and actually drive through that initiative. But it's lower stress in that business results are sort of slower, and you create value slower, and you have more time to do so. Um, uh, uh, but it's riskier in that there's less liquidity. Once per transaction, you're risking more capital than you are on a public basis, right? You may invest in a private equity investment that is 100 million, and you will never do such a trade in the public side, and you wouldn't worry if your 100 million is going to go to zero one day. So that's sort of the puts and takes on the private equity side. And on the public side, things are a little different. Instead of private equity running their 2,000 line models in order to get every assumption right to get to the fifth year, multiple investor money, public equity investors do back of the envelope math. They want to see, with this news that came out, with this reaction, how would the stock react? And in 2 to 3 years' time, we don't know what will happen to the stock, but directionally speaking and magnitude wise, where is it going to go? Is it up or is it down? And the second thing is, whereas private equity at the end of the day, you kind of close your laptop and go eat a dinner, and not think that much about work because deals are on a transaction by transaction basis. But public equity investors, your brain is sort of always on. And a lot of people self-select into the industry because their brain is always on and they want to win. And, for example, during the weekends, if a lot of headlines come out, you have to start thinking about what will happen during Monday Open. Because if you don't think about it, someone else who's also investing is thinking about it, and they're going to be making the right calls while you are kind of caught flat-footed at market open. So just a little bit of differences between these two. Also, kind of personalities I select into both of these industries. But to be totally clear, I think both industries are great industries to be in for people who are very intellectually curious and who are very hardworking. And both industries that you'll do well in if you enjoy it.
Amazing. Love that analogy. I think very eloquently put. Kind of the team dynamic versus kind of the in private equity you might be doing 1 to 2 deals a year, right? Whereas in kind of the public side, there's a lot of sort of movement activity, and you kind of have to be really nimble around that stuff. So thanks, Tim, for we're gonna dive in, like I said, to both sectors and really dive in here. I think I guess very quickly on your experience with Onefinnet. Obviously, Tim's not only a panelist here, he's obviously a, great, mentor and a professional with kind of all the networking side as well as a coach on our platform. So really quickly, maybe talk about, your experience with, Onefinnet as sort of the largest platform here, right? Across training, learning, networking, recruiting, all of that. Any sort of, advice to professionals on kind of leveraging their networks and leveraging kind of learning opportunities and so on.
Yeah, I would say, this platform is how much you want to make out of it, basically. I think the network and the resources, the domain expertise and the know-how across Kaushik, your own network, and also just this platform network is really, really deep. And, students who come into the platform, I think they don't necessarily know that they're just touching the tip of the iceberg, that there's this, whole set of curriculum out there that's available across different across different verticals. And all of these mentors from all the way from an analyst in investment bank to MDs at investment banks or private equity firms that they could potentially reach out to. So I'd say number one, that's number one. I think number two, what I've seen with the platform on the mentoring side of thing is, we have a variety of different students with different calibers kind of coming in different stages of their recruiting career, and we're able to sort of pick them up, wherever they are in their journey, and sort of tailor craft a solution for them that overlaps their ability to accomplish, and also sort of what's viable. And I found that striking that balance really is accretive both for the students and for the mentors as well. I think it's a very fulfilling experience. We've had a few candidates that perhaps came in the process a little later, don't quite know what investment banking investment banking recruiting entails, which is where sort of our value add is, and we're able to very quickly bring them up to speed, and actually get them something that they didn't think they were going to be able to get prior to join the platform. So I think both for the students and for the mentors on this platform, I think it's a very fulfilling experience.
Yeah, I appreciate that, Tim. I think to just one thing, the my as most of you guys know, my background is in the private equity space, and prior to that, kind of in the Goldman Sachs investment banking as well, like Tim. And really, a lot of the rationale is like obviously we do a lot of work with firms and funds on their kind of strategies and sort of the M&A side, the talent side, the AI side. But really, since 2021, where it started in a small manner and it's kind of expanded every year, we've really impacted over 100,000 students and professionals at every firm, in every place in the world. So I think that's truly kind of what Tim's talking about across the variety of the platforms that we have. So appreciate it, Tim. And Tim's obviously one of our all-star coaches, if for anyone that's sort of into that space as well. Cool. So let's dive in, Tim, on the secondary side. I think so. Let's start with kind of each of the asset classes you talked about. So maybe let's dive into secondaries first. So if you can just quickly talk about what is a secondaries firm, what do secondaries investors do, what is it day to day, what's the goal, and kind of what is the most important things to look at if it is a space you either are interested in or don't know a lot about yet.
100%. Happy to dive into this. Personal passion of mine, even though no longer in that specific strategy. But secondaries as a strategy has always been around. And it kind of had a little bump, a little surge after the dot-com bubble, where there were a lot of VC funds, early VC funds that got saddled with a lot of toxic assets that they cannot exit. Private companies that haven't IPO'd or didn't get to IPO prior to the crash, that they're sitting on huge losses on, and that they're willing to kind of offload at huge, gigantic discounts. And that's when kind of secondaries came about, where secondaries firms, private equity firms will organize some capital and buy out, these VC funds. The VC funds are happy that they're getting bought out, maybe even 10 cents on the dollar. That's some value back. And the secondary funds feel like they've gotten some type of value and a deep value discount for the investment that they made. But from the early 2000s all the way up until 2020, secondaries has been somewhat of an obscure and niche strategy. Because a lot of people think that there's kind of no moat to the strategy if you're able to kind of piggyback off of a VC fund's idea, their idea generation. What really is your value add? Right, because ultimately speaking, you're not doing a ton of your own diligence. You're sort of buying on value, buying based on comps, et cetera. You may have a directional view of where the company is going, but ultimately you're still having the person you're buying from do most of the work for you, and you're kind of gaining your conviction level on the asset because this VC fund, which is reputable, is buying it. That's been sort of how the industry has been structured. But starting from 2020 is when the industry became really sophisticated and very, very mature. And that was catalyzed in part by COVID, the first stage. So COVID, for a lot of private equity portfolio companies, is a 3-year lost business performance year. Revenue didn't grow that much, maybe even dipped. So they needed maybe 3 or 4 more years to get to pre-COVID level revenue, pre-COVID level earnings. And that in itself, caused a lot of private equity firms to re-underwrite their investment plan. Originally, maybe in 5 years' time, they're expecting 2 times their money, but now they only get to 2 times their money in year 8 because they've had to kind of make up for this curve in earnings, right? And maybe there's also some multiple compression involved with certain businesses because of COVID impacts as well. So that's sort of what happened between 2020 and 2021, and that spurred a lot of private equity investors to look for alternative and creative ways to drive liquidity. They don't necessarily want to sell their business at a loss and at an under optimized earning, under optimized multiple during this kind of trough period. But they still are getting calls from their limited partners saying, "Hey, I want my capital back. This is like getting a little out of hand." By 2022, by 2023, some of these investments that are supposed to be exited have been held off. So they're kind of 2, 3 years late from their liquidity targets. So LPs are calling private equity firms, asking them, "Hey, we want our money back. What is going on with this?" And we saw that on the sheet, their value actually came down. What's going on? And this is the second phase of what catalyzed secondaries. As you remember, in 2023, rates went up by quite a lot. And what this means for a lot of equity investors, both public and private alike, is that it's a risk off mode. People started, what that means manifests in mechanical terms is people started looking at, instead of looking at EV over revenue, they started becoming a lot more, stringent and started looking at EV over earnings. All right, you got to start cutting costs, belt tightening, et cetera. So this caused even more contraction in earnings and even more contraction in multiple. But beyond that, what's really the most important that catalyzed secondaries is the shutting down of M&A and IPO markets. No one really taking any risk. And this is when LPs really started dialing their private equity partners, saying, "Hey, I don't care what you do, you have to figure out a way to generate some type of liquidity for us, even if it's partial. We just want this amount of money back. We don't care if it's from that investment, from that investment." So I would say this, the rise of secondaries private equity is in collaboration with private equity firms. So you've got a lot of experts who've been in the market. Maybe they're doing certain strategies, doing minority recap, so buying just a little piece of a company, or they're doing continuation vehicles, which is you're switching out your LPs and you as a secondary firm become the LP. So you're providing liquidity to that LP. And the reason to do that is because GPs, the private equity firms, don't want to sell the asset just yet. They think that they can squeeze maybe 2 times more money in the next 5 years. So they exit their LPs currently at a kind of a higher cost basis so that they earn a little bit of money. And we as a secondary investor become their new LP and kind of take that ride to the finish line and finish the game. Um, so these secondary investors started really piling in and working with private equity funds to figure out kind of bespoke strategies. And secondaries is a little different than private equity in that, yes, you've got these common tools. You've got minority recap, you got continuation vehicles, and there's a niche one called NAV loans where you're collateralizing, you're getting upfront cash. The companies getting or employees getting upfront cash by collateralizing their equity stake, and the math there is just to figure out how much that equity stake is worth. You've got all these tools, but each deal is completely different. You can think about secondaries as their primary objective as driving liquidity for private equity firms, but also number two, servicing private equity firms to get to sort of a win-win solution for you as a secondary investor and private equity firm as the sole underwriter. A lot of times some of the things we look for are okay. The private equity firm, you have been in this business for 6 years now, and you're sitting on 2 times return. I'm just coming into the business at 0 times return, basically. Sorry, at 1 time return and not making any money. How can we align our interests such that you don't sell the business 1 year later and not notching a 2.5 times return and we just get 1 time our money, right? So a lot of it is kind of negotiation on making sure that the incentives are aligned and we can adjust purchase price for that. We can adjust certain terms for that, hitting certain KPIs, etc. The second type of sort of things that we look at, very generally speaking, are the liquidity. Ultimately, secondary investors are still bound by exit liquidity. So if private equity firms expect this asset to not have a ton of liquidity at the end, i.e., no one's going to buy it, chances are you're probably not going to be able to generate liquidity on a secondary basis from these private equity guys because they think basically the same way. The second thing that we really look at is liquidity and time horizon. A lot of the reason, one of the biggest reasons why people invest in secondaries private equity funds as an LP is that you get private equity like IRR, so 25% to 30, 35%, but within the shorter period of time, so within 3 to 5 years instead of 7 to 10. That allows you to recycle your capital much faster at a much higher frequency, invest in deals at a much higher frequency, and then get the benefit of recycling and compounding during the fund life. Because the secondary fund's fund life is still the same. It's still 7 years, same as the private equity fund, but then they're able to do higher velocity deals and exit at a higher velocity rate and then reinvest at a higher velocity. So that's sort of the idea. And in the interim, because the capital is coming in and out, LPs, don't have the same issue as private equity where, they invested in 5 businesses, all of them are in year 8, and none of them are generating liquidity, and there's no money to be gone anywhere. And the private equity firm doesn't want to do a dividend recap because they think that, their business is going to do a lot better. So that's just a little bit about kind of how you look at secondaries, how it arose, and happy to talk about yeah, where it's going and et cetera.
Yeah, actually, why don't we go there? And I want to ask about how you actually underwrite, how you price these assets in a little bit more, or stakes, I guess, in sort of a little bit more detail. Maybe you talked about the growth and drivers there. So, I guess, at some point, assuming like rates, there's movement down, and sort of it sort of creates more general liquidity in private equity, and that could take a cycle, and then maybe M&A markets come back, and that gives you more exits. So what do you got? I mean, have we reached a point where secondaries is going to be a key component of, liquidity and sort of returns going forward? Or is it like going to expand during times of contraction and sort of, and during times of expansion? So where's kind of, would love to hear about your outlook for this space. It's hard, we can't be definitive, but kind of where do you think this is going?
Yeah, 100%. I think the current growth rates that we're seeing is likely going to moderate going forward. It's likely going to moderate because of obviously it's coming off of a higher base now. And number two, generally speaking, as markets come back to being more risk on and as rates come down, M&A and IPO volumes have been coming back. This obviously kind of dampens secondaries volume quite a bit. Because instead of a kind of a partial exit, now companies have the option of potentially putting the entire company up for sale or IPO in the business. So with general public market environment getting better, you do see some dampening and sucking out of air from the secondary space. That said, that's sort of the offsetting effect. That said, there's still structural kind of growth and ideal drivers for secondaries. For example, I think one of the biggest ways you can see this is secondaries is being adopted by firms as a de facto way of driving liquidity. Prior to this is sort of a niche way, like one private equity partner will ask the other private equity partner, "Hey, did you start your business yet?" No, I did this kind of weird thing where I drove liquidity and it's a weird, super weird structured product. But fast forward now, private equity partner would just tell them, "Hey, I just did a CV." And it would be a perfectly okay thing to say with no negative stigma. Everyone understands it, and as a result, more private equity firms are doing it. So, so I think yes, as the markets are kind of booming, coming back out, you'll see some moderation, in part driven by bigger base, but in part driven by private equity firms having just more alternatives now. But now you see investment banks organizing their private capital advisory around secondaries. So even if the markets were to come back, I still think that structurally speaking, we have now established a pretty institutionalized secondaries market with actual brokers, in there that's consistently facilitating transactions. So this is going to be a de facto way of going about it. And the third reason is, private equity firms don't always want to put up their entire business for sale. Not necessarily. They always think that there's some type of value down the road. They think that potentially there might be some information advantage with partnering up with the specific secondaries firms because they can get kind of some information to other businesses and read through to other industries. And or they just want to drive some kind of interim liquidity, just want to sell 20-30% of their business, call it that, appease their LPs and keep compounding their asset. So for a variety of reasons, it will moderate, but it will continue to grow at a pretty healthy pace going forward.
Amazing. I think that's a like really great answer. Let me just like I have so many questions, but I'll kind of go to the next question, which is maybe just talk us through the underwriting process, right? So in private equity, you're looking at, okay, one asset or one platform, and then you're saying, hey, this is the overall trends from an industry perspective, industry going at X, is our market share, here's kind of where we think we're going to go. And then underlying, here's where the revenue is growing, here's where the expense is growing, and here's the leverage that we put on the business, and and boom, here's sort of the 5-year outlook and so on. So that's in some ways maybe a little more straightforward than in sort of the secondary space where you're presumably underwriting several assets or sort of other factors. I guess I want to dive into the continuation vehicle and like afterwards, but just talk to us a little bit about some of the more technicalities of underwriting. How does a great secondaries investor, like the actual process of what are you looking at, what are you valuing, kind of how do you build those models, what assumptions are you making, how do you validate those assumptions and sort of get to that final answer, and maybe what that package of the secondary sort of fund looks like across different different sort of underlying assets, I guess. So I'll leave that there. Tim, if you want to help us kind of give more insights into that topic.
100%. I once heard that, the best secondary investors is someone who's friends with everyone in the room. because you're able to kind of buy pieces off of every single private equity fund portfolio companies, regardless of who they are. Right, that's part of the appeal of being a secondaries player. You're a neutral party. You don't compete with the private equity firms. Therefore, the private equity firms would want to do business with you because you're an Apollo trying to buy a piece of KKR's asset. Why would you want that? What's your angle here? What's going on? So how do we look at business? I think we can kind of split this down the middle into single asset and multi-asset, and because there are tactically different ways of looking at it. And within those two buckets, in the first one, you can do either a minority investment or a continuation vehicle. We kind of talked a little about what continuation vehicle looks like, but if you were to just look at a single asset continuation vehicle, we look at basically the exact same things as a private equity client. What is our purchase price? How much are we buying into this business? What is the multiple? What is, discount or premium compared to comparable companies? Um, um, you know, the same exact EDO driver, same exact kind of modeling, but there are a few things on top of that that we have to consider. I think number one is for continuation vehicles, there are fees associated with it. So because we are becoming the LP of that specific asset for that GP, we actually pay a slightly reduced management fee of 1.1% to 1.5%, whereas regular LPs pay around 2%. So we have to do that math. To make sure that it works. And secondly, on the exit end, when the single asset CV actually exits, we take the private equity firm takes a cut of that asset, similar to how LPs are structured. But instead of a 2 and 20 model, it's more of like a blended 1.5 and 10 to 15%. Right. So we take a bit more, they take a bit less for the extended duration that we're taking on to this that they're taking on for this investment. So we got to run that math, make sure that our entry price makes sense. And generally speaking, for entry price to make sense for secondary investors, the entry multiple tends to be a little lower than private equity investors and a little lower. So we do require a discount because CVs are fee generating assets for private equity firms, and it's a net kind of leakage for us. So on a net basis, we got to make sure that our model works. So usually we'll demand a discount, and you'll see a lot of secondary firms, kind of out there saying they have an average 25 to 30% discount compared to the latest public comparables. And I think that's a good metric, and that's fairly accurate. That's generally what we look for. Secondary investors generally don't invest in an investment unless there is sizable discount. So that's one. And I think number two is if you're looking at both single asset and multi-asset continuation vehicles as a secondary investor, you are necessarily not going to be in control of the asset. You are going to be an LP of an asset or otherwise a minority shareholder. So an additional layer of diligence that we do is on the private equity firm. So basically, the main underwriters' ability and track record of generating good returns. Like how consistent are they in generating returns, and also how good are they in this particular industry? And do you personally have conviction in the team? Because after you invested in them, you're not only investing in having conviction in the business, but you're investing in the private equity firm being able to deliver on the value creation plan that they set in their materials, right? And if you truly believe in the capability of maybe a partner or a few partners in the firm because they're really good at this industry in the vitamin segment, for example, you're going to have information asymmetry and edge in investing in the deal. Everyone else just sees a deal, but you see that this private equity firm has amazing synergies and amazing domain know-how. So that's the second. And the third, when you're looking at, this is when things get really interesting. I'm glad that you brought up multi-assets, continuation vehicles. This is when things gets really easy because if you have a basket of say 5 to 6 different companies, and you're in a bidding process with another firm, it becomes a gameplay of, okay, what is your view on how much value you want to put on each of the business? And the person who is requesting the bids wouldn't know how much you're putting on each of the assets, right? So you need to have a house view on those things. So, but at the same time, you don't necessarily want to grind your investment team to spin up diligence on seven different companies within a month or 2 months, right? Secondary transaction processes run very quickly, and you don't have that much resources. So usually, what you would do is you will pick out kind of the top 3 or 4, value driving, value generating assets, and based on public comparables, based on industry checks, et cetera, place your own value on that and compete for that deal. That's when things really, really get interesting, because of the competition aspects for these deals, on kind of game theory on, hey, we're not a control buyer. Like we can't control when we sell the business. We also can control the strategy of the business. So on a game theory basis, what are all of the possible scenarios that could go wrong? And we go and patch that up, the downside with maybe governance negotiations or minimum return thresholds, et cetera, to the extent that we can get them. If we can get them, maybe the deal won't get done. Um, but that's a little bit on the minutiae of it. But on the exit end, it's the same similar structure in that if private equity firms have issues exiting that business, the secondary firms are also similarly going to get hit.
That makes a lot of sense. I mean, great job kind of diving in here. A couple observations, and you can kind of just quickly answer them. So one is, looks like that discount is as much for mostly just for the liquidity, right? Sort of providing them liquidity at a point in time that's earlier than they would had they stayed on and so on. So that makes sense. I guess 25 to 30% is obviously meaningful. So the LP has to exiting LP or whoever is getting has to figure if that discount is sufficient for them to get their money out 2 to 3 years early or whatever. Right? So that's the put take there. Maybe the second comment is uh, as you kind of think about the diligence aspect, I guess. Tim, one follow-up question, like, um, are you like, or just the sourcing aspect? So you mentioned brokers and stuff, but are you tracking potential distress stakes and things like that? Like, what is going on in the sourcing side of this? Because you said it is competitive, and you said sometimes when you look at multi-assets, you need to have a view in like 3 to 4 weeks on 7 different assets. So maybe talk a little bit about, again, generally, not specific to what a fund does, but like, are we tracking all the different stakes out there? Or are there companies, telling us, hey, this might be coming up? And then maybe the follow-up question there is unrelated, related, diligence wise, it looks like sounds like a lot of the diligence, or at least from my experience and kind of interesting, this is actually with the PE fund itself or the GP versus with the management team as well. And so maybe talk a little bit about is that true on the diligence side? And if so, like, how you just can't get comfortable with the PE firms, projections versus getting from like the end source, I suppose. So maybe you can touch on some of those points.
I'm really happy you asked that question. So we can talk a little bit about diligence side first. Yes, there's a really big emphasis on diligence in a GP and your conviction on them to deliver on their value creation, and also whether or not they're good people, whether or not they're lying on their projections, are they being too optimistic, etc. Um, on the company side, it's sort of exactly the same way that you would look at any private equity investment. You kind of have a house view on something, and you really dig into that business. You do channel checks, you do the same kind of GLG calls, talk to, potentially some sell side analyst if they also cover the same industry, but some of these businesses are private. But you're right in that there is much less management access when it comes to secondary transactions. Because ultimately speaking, unless they're the ones driving liquidity from their employee stock option plan, which is also a part of secondaries, which we have also done before at W, it really doesn't concern them, right? Because their owner is ultimately going to be the private equity fund, and it's just the private equity fund exchanging their LPs, right? But generally speaking, nowadays, because secondaries has become more institutionalized, usually they would open up a management access for maybe 1 or 2 meetings. It wouldn't be as extensive as a private equity transaction where everyone sees each other basically every single week to go through diligence to make sure that it's a marriage, right? So you want to make sure that the partnership is solid, before moving in. Um, so that's definitely a slight difference. So you, as a secondary investor, are working with less information, less access, less information asymmetry kind of edge. So as a result, your this is very interesting. So compared to private equity, secondary is actually more like a stock selection, right? It's more like a stock selection in that it's higher liquidity. You're working with less information, but then you're making educated, informed investment decision based on a variety of factors. And that's a little bit more akin to public market investing than private market investing. Um, I want to talk a little bit about sourcing because this is when it gets super interesting as compared to private equity. Private equity sourcing is you buy entire businesses and you go and you build relationship with management teams. You track private businesses. Once they get to a maturity with cash flowing business, that's when you approach them and buy. Maybe you establish some relationship with Series A founders. By the time they get to Series D or E, it becomes a growth buyout opportunity. It's very similar in secondaries. But then the only difference there are two differences. You get to basically pick off any asset from the venture side all the way to super mature cash flowing businesses. That's number one. And number two, you get to interface with not only management teams, you get to interface with management teams, private equity firms, and employees. Anyone basically that can drive some type of return, that have some type of private share to sell. that they want to drive liquidity from. So we haven't talked about management, management team or employees, ESOP, employee stock option plan being a secondary source, right? So a lot of companies have been staying private for a much longer time, meaning there's no liquidity for the employees at all. But there has to be someone to buy them out at a higher cost basis, than when they got issued that, right? So people can plan their homes, like my company told me that I can get my ESOP, cashed out 10 years ago, but I've been married 10 years and haven't bought a house yet. My wife is pissed. And we come in and we provide liquidity at a site discount for these employees and for these management plans, cleaning up the cap structure before IPO and making sure that the employees are happy and they're continue to stay incented to be in the company. So you interact with a lot of those people, and these are like VP of engineering, CFOs, CEOs, anyone that has a need. That's where we source it from. So this would be going to industry conferences, keeping a really regular dialogue, a personal relationship with these kind of management teams. Secondly, um, you will find that secondary investors literally know every single private equity heads in the industry, right? Your network there is where your deals come from. Private equity head may be like, hey, this asset has been giving me so much issues. I'm not able to exit it, but I know it's a really, really good asset, just going through a few tough years. Would you want to buy it? Right. So, a lot of secondary investors are super great friends with all of the private equity firms on the street, because of what I just talked about. If you're a neutral player, you're friends with everyone, you can get deals from everyone. And the last one, and the last one sort of is, kind of talked about. You can track a business from venture stake to growth, and maybe the founder doesn't want to do this anymore. Maybe he just wants to be cashed out. You become the secondary investor to buy out his stock or something like that. Or a VC fund. This is one last example I'll give before we move on. This is really interesting in that you talked about, the liquidity discount. What the term that we use in the industry is called motivated sellers. We don't call them desperate sellers. I used to call them desperate sellers, but they're motivated sellers, where there's this unique situation where this VC fund has been there for 15 years. It has a very long and they have made a lot of money, 10, 20x money for their investors on select investments. But they have this really long tail end of investment that is, giving them strain because it's not that it matters to them that much. They've made enough money already, but this is a material amount, such that the LPs actually want to get their money back, but they don't really care how much they get back as long as they get back something since they make so much already. So we had a personal relationship with this firm through one of our partners who actually is a neighbor of this person. And they got very close over time. And we actually were able to get this asset at a discount compared to public comp, right? This is sort of a super unique kind of alignment of interest that you don't really see that much in private equity space because everything is so priced in. But in the secondary space, because there's a lot more inefficiencies, there are more human factors involved. These type of deals are what secondary investors kind of salivate for. But a lot on the sourcing side, but all that is to say, it is a lot more dynamic and a lot more fascinating than sort of traditional private equity sourcing, depending on who you talk to.
Yeah, I mean, love it on both questions, right? On sort of the diligence side, really, really great insights. And then obviously on the sourcing side, just like anything in our world, right? It's relationship driven, it's sort of, subject matter expertise driven, and then really being able to solve a real problem. In this case, it's timing and liquidity, in sort of a creative manner that, there's capital out here and there's sort of people that want that capital back or that capital. So you were kind of providing capital at the end of the day, which makes a lot of sense, Tim. Maybe just one or two more topics on secondaries, and I'm sure there's going to be after we put this podcast out, a lot of people want us to dive in even more. So Tim, I'll have to bring you back probably to go in a lot more. But I think there's kind of two concepts, right, in private equity. I suppose the larger IRR concept as well as sort of the cash on cash return concept. Talk to us a little bit about since the time horizon is a little different, it could be longer, shorter, as well as sort of the in and out cash sort of could be different sort of magnitude from private equity. I mean, talk a little bit about how you measure returns, what are you looking for, what makes good investments, and sort of what are you guys both as kind of investors, but also your own LPs might be looking for just in general on returns on the return side.
Yeah, it's tough to say. What I've seen is that prior to COVID, LPs are more prone to giving credit to IRR, right? You can hold our asset for longer, as long as you generate us good IRR, right? But increasingly, you see a few funds having to extend their like large funds like Blackstone's Apollos having to extend the duration of their investment, and it's happened so many times such that LPs literally, are having no cash, right? In. And there's also a sort of a the denominator effect that happened in 2020 and 2021, where public markets drew down by a lot. So for pension funds and for institutional investors, all of a sudden they realize, oh crap, like when I look at my capital allocation, it's now super overweight private equity funds and super underweight, public equities. And that can't do because we need to have high liquidity to maybe fund some of our pension plans, to fund some of our insurance plans, et cetera. So they have this kind of reset where they stopped giving as much credit to sort of IR math and they want absolute returns right now, right? They want to kind of reduce the risk that they're taking. They want higher velocity, which is part of the reason why secondaries, gain a lot of traction. And private equity, it's kind of both sides moving together, right? Secondaries is exploding, but also at the same time, private equity firms also trying to decrease the duration of their investment to not piss off the LPs as much. So that's sort of like general, industry trends, whether or not once rates come down and private equity firms start making money again and their bargaining power becomes larger, all of a sudden, the investment documents are now 7 to 15 years, with no need to ask for permission on extension. That may also very well happen. But I think that the age for that for private equity firm is probably long gone.
Very fascinating. I think we're seeing that obviously in the private equity space as well. I think a lot of things, right? Rates, macro, sort of growth, valuations, exit, competition, to your point, publics as sort of a comp to kind of where you're getting it, time horizon. There's all the factors you're saying we're seeing on the private equity side equally. And in some of these really benefit secondaries, and some of them are also headwinds, I suppose. I guess last question here, right? Maybe without naming particular names, but like maybe give us like on a case study side, I suppose, example of like or types of things you look for when a company looks really great on paper, but ultimately you're digging in and you're like, you know what? There's a reason why there's been no exit or liquidity here, right? It's kind of less of a high quality asset. And frankly, that might also touch a little bit, Tim, on a little bit of a conflict of interest or kind of information asymmetry, right? Like the reason why certain companies may still not have an exit is could be good, but it also could be not so good, right? So maybe talk to us about some of that. And then maybe on the other side, something that didn't look so great, but then you dove in and you're like, hey, this is actually a lot more interesting and there's some unlocking of value here that maybe the PE fund itself or is not realizing. So just again, doesn't have to you don't have to name names per se, but just give us a sense of some of those examples that you may have seen.
Yeah, 100%. I think in in looking at software, a lot of the times you get kind of blindsided. You read about the product of this, what the software does, and you're like, okay, this is such a great idea. So there's this one company, I'm not going to name names, but there's this one company that looks at the stability of your cybersecurity stack and then ranks it. So similar to how you have credit scores for as a credit holder, they give you a credit score. So institutionalized, everyone knows that you have a 750, 800, FICO, Equifax, score. You're assigning companies the same score, but for their cybersecurity. And what this does is that, when these companies buy cybersecurity insurance, they have some type of a comp, some kind of a bogey to go off of. And they're also able to tell their investors like, hey, we're really strong on cybersecurity. This is our tech stack, etc. Ostensibly, that sounds like a really great idea. Like there's a use case for it. And the company, seems like it's printing, money, and it's growing pretty well. Um, but upon looking into it, the software space is really fascinating. That's the kind of the industry I focused on mostly during my time in the secondary shop. A lot of these ideas sound very, very good, but then a lot of these ideas at the end of the day, number one, will be disintermediated very, very quickly. If Moody's were to create a similar product, this company is basically done because this is all they do. And S&P has much larger, database on everyone's ESG, cybersecurity, credit scores, etc. Secondly, just because this company is growing a lot right now, doesn't mean that their solution doesn't have a ceiling. We talk a lot about software as being point solutions or being best in class or being full stack. This would be considered a point solution where you might grow to a certain degree and then you're starting to bump up against market share from super large guys, from Palo Alto or from CrowdStrike, for example, and you cannot take the contracts away from those guys, and you kind of reach a ceiling there. And in order for you to get those customers, you need some, a drastic incremental increase in your capacity to get those customers and your product capability, which won't be there until you spend like a CrowdStrike or spend like a Palo Alto. So a lot of these businesses, they sound super great, and you see the valuations keep going up, but it's a tale of two cities where the companies that actually do go up will continue to go up, and the companies that kind of just plateau, they end up just kind of dying out, kind of into the wind. So that's sort of one. So for software businesses, you have to be really, really careful of the actual product itself, whether or not this can be sustained, not just looking at obviously the financials, et cetera. Um, a sector that I found to be relatively boring prior to looking at it, but after looking at it, found to be incredibly powerful across the economic cycle is the QSR franchisee space. Never heard of it before. No one thinks about it. You pass by a Chick-fil-A and you wouldn't know that Chick-fil-A is the highest earning average order volume in the QSR space at all. Right. So McDonald's, they earn about 3 million in revenue per year, average. Chick-fil-A, and then they're number two or three on the chart in terms of that magnitude, that ranking. Chick-fil-A is 14 million revenue. They are double the largest earning QSR out there, right? You never think about those things, and they're all franchisee run, etc. And when I looked into the space, I realized number one, secular trends actually do matter a lot. You would think that you wouldn't want to invest in a KFC or a Taco Bell or a Chipotle or Chick-fil-A. You wouldn't. Who would do that? It's fast food, man, right? But this industry has grown through COVID, has grown through '08 at 5 to 7% very consistently compounding, right? And for certain verticals such as chicken and such as Tex-Mex, has actually been growing 5 to 7% plus maybe 200 to 300% spread on top of that if you're an industry leader, right? Um, and but back at the firm, we actually invested in a Tex-Mex QSR because we think that it indexed really well to the higher end of the growth, the spread that we talked about. Number one, because people are really into sort of chicken and Mexican cuisine and like fusion. And number two is Tex-Mex cuisine tends to be more of a trade down option. So when we did the deal in 2023, they were going through a surge where a lot of Chipotle or maybe fast casual customers are moving downwards, are trading down for more, lower price items. So we're seeing kind of a tailwind going there. And on top of that, this is a very, very stated formula of your same store sales growth is maybe growing, 2 to 3%. And then you maybe add 1 to 2 point on top of that with new store growth, right? And it's a very formulaic model where in the next 5 years, maybe we'll add 100 stores, and that will add a few more points, a few more EBITDA to each year, and that's how they grow. And we did a very simple kind of saturation analysis. All right, within this kind of 10-mile radius, how many Taco Bells are there? How many Papa John's are there? Like, what's the competition? All right, there's a ton of white space. Makes sense to go open, right? Previously thought it was super boring. Why would anyone invest? But now it sort of makes sense because this is what we consider an infrastructure-like investment, even though it is actually not an infrastructure platform. But the return profile and the cash flow profile yields it such that it's basically a super resilient asset no matter where you go. And in fact, it's counter-cyclical in that when people are belt tightening, this company actually does a lot better because it's just lower price food. So that's one. And I realize also if you're a franchise owner and you have relationships and you have expertise in running a franchisee, you can always tuck in an additional brand under your company. So this company is the largest Tex-Mex franchisee in the US. They think that their growth is not enough, right? Well, how would you choose growth? You can't open, faster, more stores. They bought, the franchising right to a drive-through coffee place, for example, and this coffee place is growing 100% per year. And they saw that there's overlapping kind of geography. So they develop mainly in a specific area in the US. They know the labor laws there, they know the labor codes, they know the productivity, they know the street corners, right? QSR is all about traffic capture. They know all about that. So they decided to buy the franchisee agreement of that kind of coffee, new novice, innovative coffee brand. And that actually added a lot more to the growth and profitability of the business because your beverage margins are basically 2x that of their traditional kind of food business. So that all that is to say, I think, traditionally sexy industries like software, people gravitate towards it. But I think there are a lot of things that are potentially smoke and mirrors. You have to really dig into the product itself. Whereas, if you look at some of the industries that people are not finding as sexy and that no one is focusing on now because it doesn't have an A or an I in it, it's actually growing super well and like super resilient, and people want to invest in it because the formula is de-risked. It's there, and if you can find the right partners to run it, you're going to make money. So that's sort of a quick primer.
No, that was awesome. I mean, fascinating. I agree with you on both points. And like the last point you made, it's kind of like a roll up in like a micro market, like kind of a neighborhood or kind of a geography, across, um, kind of couple different types of products or whatever, right? So kind of that's what you're describing, right? You understand the market, you have a coffee shop and you have sort of a, quick service restaurant, but then your niche is like you get that space, the micro market, and then there's a lot of roll up ability across marketing, across sales, across cross sell, across, other things that you might have there. And so that makes a lot of sense. So amazing job, Tim. I think so we've kind of delved a lot into secondaries. Can we now pivot to the hedge fund side and just give folks a little bit of a primer on on just kind of the space and we'll kind of dive in there. So let's start if you can, Tim. Obviously, so great job on the secondary side. So that's number one. So thanks for doing that. And then on the hedge fund side, maybe where we can just start is for folks that are interested in this space or just broadly looking at the hedge funds sector as a whole, maybe talk to us a little bit of how you think about the world, like the different types of strategies, some of the key differences, and maybe what type of people might succeed at sort of like a macro fund, right? Versus sort of a long short versus, other strategies. Maybe talk to us about the different strategies, the types of funds out there, and then kind of what types of backgrounds and people and type of qualities and characteristics that might make people successful in each of those strategies.
100%. I think if you're talking about the public side, we can sort of bifurcate it into sort of three different buckets for equities. And then we can talk a bit more about, some of the other strategies that are run, but the different types, different ways in which people organize to trade equities and share in the profits, there are a few. Number one is sort of my workplace, which is what we call long short equity or a pot shop, or otherwise known as multi-manager kind of structure, where there's a platform that goes out there to raise a certain amount of capital. They then allocate that capital to each pod. So these are teams that run capital, usually headed by a PM that controls all investment decision, and he gets allocated capital. And then he then allocates capital to analysts beneath him that are focusing on specific industries. Maybe he helps trade with one of them if they're earlier in the curve in the industry, in their career. But if it's already an analyst or a senior analyst who's been trading for a long time, maybe he just lets him be, and just take a take rate off of his profit. And also kind of like ask him about certain investment advice, certain investments in their industry domain, the industry where they are domain experts in. So that's sort of posh up structure. Um, and then there's what we call single managers. So this would be, and Poshup, sorry, because Poshup, some of the firms out there are Balyasny, Citadel, Point 72, etc. For single managers, this is a fund where, you're probably trading some outside capital. Maybe some of the capital is the founder's own capital because he's very wealthy. But all investment decision will go through one CIO/CEO. And this is the person that owns the fund. So think D1, or Jericho or Elliott, or Pershing Square Capital, where there's like a very main figurehead up there that controls all investment decisions, sourcing, etc. There might still be PMs, but all investment decision flows through that single manager, right? So that's sort of the second bucket. And the third bucket, if we were to talk about everyone that trades equity, are sort of the mutual funds of the world, the ETFs, the BlackRock. So those are more, you invest and you hold it, don't really think about it, put it in a drawer type ideas. And also long onlys that only long, they don't short. Single manager and pot shops both short. We'll say in terms of sort of like stress of your job, um, long short tends to go, more short term. They're fast money, so they tend to be the most stressful. They have to digest headlines, be up in the morning, look at sort of super minute detail changes, day-to-day data, etc., and then figure out trends there. Whereas single managers tend to be able to take, since they kind of are a proprietor of their firm, and they're not restricted by the risk box set by the platform because they are the platform. They set the risk box. they can take a longer view. They can take a higher drawdown and longer view, maybe a year, 2 years, 3 years, and actually look at stocks based on the IRR term, not just based on percentage change. They can think like a private equity investor. And then the third, the Fidelities and the mutual funds of the world, the BlackRocks, they have an even longer time horizon. They move size, and everyone knows this, but BlackRock is the largest single shareholder of the global equities market, number one. So that's sort of on the equity side, which is what most people are interested in. But within the same kind of three structures, paw shop, multi-manager, single manager, and mutual funds, etc. There's also the mirror makeup for each strategy. So there's quant-driven strategies that uses algorithms to trade. There's commodity strategy. There's macro strategy that doesn't trade on individual stocks, but trades on Fed movements, Fed expectations, etc. There and yeah, so those are kind of like the strategies involved and on the public side.
Amazing. I love how you explain things, Tim. I think it's, even for both experienced and for beginners, I think it's super helpful with the analogies and everything that you're talking about. So effectively, like, Tim said, it's a little bit about figuring out kind of what type of environment that you might want to work in. Kind of one is the strategy, right? Like, do you want to just focus on, equities, or do you kind of have a sense of you have more of an economic background, or kind of have a, more of a specific product type, commodities, fixed income, whatever it is. Then it's a little bit about what type of environment you want to kind of work closely with a PM on sort of a strategy as part of a larger diversified sort of pool, or are you kind of more aligned to learning from a certain type of large investor, but kind of have a little bit more of a long-term view, right? Versus kind of more of the kind of the multi-manager side, or do you want to have a very long-term view on sort of the more the mutual funds of the world? So a lot of everything that Tim said and everything our speaker said, I would try to internalize to, hey, this is the type of environment where I think I'll be successful, and if obviously you're trying to get in. And so now we'll get a little bit to the keys to like success on the job. So let's say you're looking to, you're in the hedge fund space already, you're more junior, or even kind of wherever you are, or you're looking to get in. So Tim, talk to us a little bit about the day to day, and sort of what it takes to be successful, just from a macro view, like people you've seen, you admire, or you've mentored who are successful in sort of the public investing side. What do they do well? And what are the skill sets that they should be picking up over their career?
100%. I'm happy to talk about that. Um, uh, I think people go into and stay in the public side successfully, mostly because of interest. It's not because of pay. I mean, you hear about all the hedge fund managers earning a lot of money. Yes, I think for the ones that are successful, they are able to earn, multiples beyond multiples of what other people are able to earn in the same kind of Wall Street circle. But for you to stay in the industry, you have to have respect for the fact that it is incredibly hard. And people do it because it's incredibly hard, and people do it and stay there and succeed because they like to win against something that is really, really hard to do. I think that's just the defining characteristic of an equity analyst. I'm not professing to say that I'm there. I'm certainly not there. I'm sharpening, on honing a lot of the skills that's required to be successful in an industry. But a lot of very successful PMs or senior analysts I've talked to, they said number one is you need to want to win consistently. You want to be able to you need to want to compete because it's different from private equity where you might be able to find some inefficiencies. Public market is so transparently efficient that if you're already thinking about something, someone else out there is probably thinking the same thing. So where's your alpha capture? So you either have to be faster, more knowledgeable, more right on your decision, or simply be more disciplined and catch more things than other people, right? So there's this innate kind of competitive spirit, and that drives you. And what it manifests as, which is the second defining characteristic, is obsession, right? It doesn't matter if you know everything about the business. Like an expert in the business won't necessarily know how to trade the stock. Uh, Someone who probably do really well trading the stock is someone who not only knows the business really well, super interested in it, but makes the effort every single morning to come and track the data for the business, track the incremental little changes in minute or super niche sources that no one's picking up, or can sense like a very small kind of green shoot of sentiment change or narrative change that's about to come that will create a sea change of people selling the stock or buying the stock. So I think it comes down to obsession and discipline. Even the most even people who have been in the industry for 6 to 7 years, it's not like they can just walk into a room, begin to trade, and make really good returns. They miss things. They kind of regret doing that, that they miss things. Okay, I went through a period of me being super disciplined. Now I'm getting a little lazier and I can see that in my returns. So let me just ratchet it back up. And so it's really two things. You need to want to win. And number two, you need to want to be obsessed over what you're doing. And I will add one last one, which is intellectual curiosity. This is one that's thrown around with basically every job interview, but it cannot be more true in the public space because at the end of the day, you as an equity analyst, you're being paid to learn about why things are the way they are. You're just being paid to do that. Once you get an information, news, a print, earnings release, whatever, your job is to figure out uh, number one, is this good? Is this bad? Which requires you to go and figure out like what this actually is. Like earnings print is good, earnings print is bad. Is this product coming out good or bad? And then one layer on top of that, which is the hardest layer and the one that makes the most money is where's the stock going to go? Right, where's the stock going to go next week? Where's the stock going to go in 1 month? Where's the stock going to go at the end of the year? And that's where the alpha and money maker is. And that's where, most people are honing their skills on because everyone can kind of react to a news and think that like, okay, this may potentially be okay. Like, I don't know what to do about it, blah, blah, blah. But real good investors can figure out, kind of connect dots. All right, this news came out this month, and I realized back in 6 months ago, I saw an incremental news that they were going to come out in a year. So this actually came out 6 months prior to that, right? So this is upside. So I'm going to buy the stock. And if you're right, you're right. If you're wrong, you're wrong. So that's one thing. And then one last thing I would say, and something that I've seen repeatedly is some of these guys make a lot of money, but they're incredibly humble people compared to maybe some other people in the industry that make the same money, right? Who are suit and tie. The reason that they're so humble is that they get humbled by the markets every single day. And I find that I align with those type of people who are incredibly cerebral, incredibly smart, brain is always on, but who reserve a little bit of benefit of doubt for what they're saying. They know a lot, and they perhaps know a lot more than the person next door who's pounding the table with confidence. This is exactly what will happen. They're a bit more reserved because they're nimble and they know that markets shift with them all the time. So as a result, they also tend to keep their egos a little bit more in check, which I align with more on a more personal basis.
Amazing job, Tim. So that is a great answer, and sort of, I think people should go back and listen to that answer around just wanting to win and sort of try to be the best you can be. Number two is obsession, as well as kind of a healthy dose of like. The third was attention to detail and kind of knowing, hey, this came out a year ago, 6 months ago, et cetera. And then I think number four, humility, and kind of putting that as part of the risk aperture, right? So I want to have some room to be wrong, even though everything else feels like this is gonna the way it's gonna happen. To your point, and I think frankly, that actually should also be true for more of our private equity people because frankly, in a course of an investment, so many things could go wrong, and even the private equity and secondary space. So I think that's a quality I'd like to see our private equity people have more of also. So I think that makes a lot of sense. Just quickly on the day to day, Tim, just in a minute or two, just
Yeah.
talk to us about um, you know someone at that kind of the level that you are, where you've a good amount of experience, and you're kind of advancing. Kind of what is the day to day, and kind of where do like best, kind of the people that you've seen, the best in class mentors, mentees, et cetera, spend their time doing and differentiating.
Yeah, 100%. Day to day looks, in terms of structure, looks pretty similar. Wake up around 6:30 a.m. Spend around 2.5 hours processing, news within my coverage, which is U.S. internet. All of the news to catch. So this would be like, sell side revisions. This would be, new AI news, which, seems to be 100 headlines per second nowadays. You got, CEOs being in conferences talking about the product, this and that, maybe new management coming out with new guidance. So processing all of those, and then figuring out what that change, what that thing changes or does not change any of your views of the company on an incremental basis. So that's what's happening before market open, for 2 to 3 hours. And sometimes there might be a stock that went up by 20%. We have a short position on it. Then you got to go and figure out, talk to sell side people prior to open. All right, what should we do with this? Should we be covering? Should we actually short even more? From the top because our view didn't change, or should we do absolutely nothing because we have no information to really trade on? And then 9:30 market open, you're expected to be on your desk, check out any big moves in stocks. If there are big moves, then you are expected to figure out why and figure out if that's a buy op or short op, etc. And then kind of recommend it to your PM. During the day, you might have some continuous work that you're doing. Maybe you're doing some research on, how ChatGPT is gonna disrupt the ad space. You gotta go deeper into that. The job is partly about reacting to really fast headlines during the day, but also probably about, okay, we need to dig deep into an industry, the industry trend, because when we're investing, even from quarter to quarter, you need to know what folks are thinking about 3 to 5 years down the line, because that drives the majority of large buying volumes. The large buying volumes actually don't come from the hedge funds. It actually comes from the large long onlys who buy and they never sell. That's the best, right? The hedge funds increase the volatility of a stock, but then the long onlys create support and create more stability for a stock for it to keep going up, right? So we for on the long side, we do like companies that have a lot of variance right now. Maybe the data is going up, but then estimates are saying that it's going down. But then there's good secular trends such that in 2 years' time, I would still want to own the business at this point in time. So that's sort of like the NAS we're doing going through the day, and then 4 p.m. market closes. Maybe you go into your PM's office, talk to them about some of the trades that we've done today, why we made them, and tomorrow if they're earning earnings, if there's anything we need to prep for. And usually from like 5 to 8 p.m. you're working on your models. You're working on refining some of the models, stuff that you didn't catch during the day because you're so focused on the spread to price movement and catching all the news, and then recommending some buy ops or short ops to your PM. And this is when you really settle down and connect all of the dots of what happened today, with any big market moves, and then figure out, okay, tomorrow morning, what should I do? Should I be watching certain stocks because they have certain things happening to them, certain events, or certain conferences, or and just kind of generally playing out the day. But that's generally the general day. During earnings, however, you might sleep around like 10 to 11 p.m. just because you have the earnings call, and after that you spend a few more hours, maybe talking to sell-side analysts and then updating your models, and then sleeping after that.
Amazing. Great job. I think that makes a lot of sense. And you can already kind of everyone who's listening, right? You can already see the dynamic between a lot of the individual work and sort of being that self-driver to figure out kind of where things are going. Especially for someone coming from a private equity or investment banking background, as an analyst associate, and frankly, even as a VP, you're getting kind of told what to do and you're kind of saying, hey, let's spend time here, let's do this model, let's do this for the client, etc. But obviously at a young age, right, you're in the public side really driving a lot and doing a lot of sort of self-driven research and sort of where you want to spend your time. And I think that really values. At the same time, obviously, you're learning from peers and senior people on kind of their history and all that. So I think that Tim did a really good job of walking us through that. A couple kind of a little more on the quick hit side on the public side. Tim, you kind of touched on this, right? Like, let me ask you, comparing what we just talked about on the private equity and sort of secondary side versus the time horizon and the liquidity and all of that versus the time horizon in the hedge fund world. So a lot of our people, right? Most people that are listening to this are either in investment banking or in private equity, growth equity, or maybe early stages of the public side and other things, corporate finance and so on. So the biggest question that hedge funds would ask them if they're interviewing them is like, you're coming from a space where you are a private equity investor, a 5-year horizon to look at something, whereas you have 5 years to, implement change and so on. Whereas you're coming to a space where you might be in a stock for like 5 or 10 minutes or 5 hours or 5 days, right? Or five, whatever, weeks. How do you retrain your mind versus how do you demonstrate that you can be nimble on sort of that short-term horizons as much as kind of long? So what are you guys looking for in some of those candidates and how should they demonstrate that?
That's a super good point. There is a pretty big mindset shift coming from private equity, uh, and it's actually generally pretty similar how both investors look at things, but how they react and their risk appetite is actually different. We still look at multiples, we still look at fundamental business structure and trends, et cetera, and competitive dynamics. All of that's just exactly the same work, but then we are a lot more sensitive to small little changes to data. Small little changes to data for private equity firms don't matter as much because you have a longer time horizon and you also have control. But for us, because some of the businesses that we're trading are gigantic. These are like $1 trillion businesses. Small little incremental change in one trend will cause pretty, outsized reactions from the market. So I think that's sort of the first thing. And second thing is things that you previously thought didn't matter now matter. in the public side. Private equity, right? If you're invested in Anthropic, for example, or if you're investing in any software business, you probably wouldn't need to be checking the news every single day, right? Because your business and the price of your business is not going to change because one negative headline came out about you. But we have to be nimble on um uh uh you know super rapid changes in the business, in the price of a business, not necessarily the business itself, right? That's sort of what we're trading on. Like this is what the news are telling you the value of the business is, but then really the value goes like that. It's a much smoother line, and we're kind of capturing the under optimization, the over and undervaluing of that, the overreaction. So you have to constantly be thinking both on the long side and on the short side. And that's something that private equity investors don't know how to do as much on the short side. How do you figure out how I should even be shorting this business? I've never really thought about that before. It's not like this company is generating negative earnings, therefore I'm shorted. No, it's there. Everything is already priced in. There has to be incremental downside to whatever you're thinking through for you to be able to short that. You have to do that in a situation where a news headline might come out, a product might come out, and all of a sudden you're squeezed, right? So I would say number one, thinking about the short side is definitely a big thing that I had to get used to coming from private equity. Number two, being at the whims of the market every single day. Think about it. In the private side, if you kind of sick one day, you could not come into work and it's all right. The transactions happen probably in 3 months' time. But if you get sick on a Wednesday night, and you have to just wake up at 9:30 a.m. in the morning, no matter if you're sick or not. Like the market keeps going, the news just keep coming, right? You can't call out sick. So that's another thing. And then the last thing, as I sort of talked about is, you are constantly having to take a view. For private equity, you're taking a view maybe once per year in the budget meeting. All right, this is my projection. What worked this year, what didn't work this year. But we're doing that exact same exercise, and we're doing every single day, right? All right, ChatGPT is coming out with ads. Oh crap, Meta revenue came down. But is it right that Meta revenue came down? It's an ad business, but everyone is assuming that ChatGPT is going to have this, the tens of billions of dollars of ad revenue. Is that even possible? And if our view is that it's not possible within this year, that means it's buying Meta. But if we think that, oh man, they're going to be making hundreds of billions of revenue, then it's shorting Meta, right? So you're constantly, this is the trend of the business, the true trend, and things are happening here. And it just depends on a great investor would just be able to call the right trends at the right time. And you have to constantly think through those things.
Amazing points. I just want to add one thing is that what the Tim point that Tim mentioned is, in IB, you're sort of not making many decisions, kind of from you. Nobody's asking an associate or analyst or frankly VP what they think of something all the time. On the PE side, it's a little bit more like when you get SINs in or you investments in, you have to take a quick view on something. On the hedge fund side, this is every view you take is actually going to be an actual trade. So the kind of the intensity and sort of conviction, I suppose, you have. So that's kind of why we see that trajectory. Number two, the other thing that I would say is if you are cross-looking at the other, the point to make is kind of what Tim said. One is, look, me being an IB or PE has frankly really taught me to understand one, business models and how actually business models are and how they operate, the pros and cons, and number two, industry, right? I learning kind of the trends in the industry and so on. And that's what makes me a better investor for the public side because I can kind of see both of them. So I think without spending a ton more time on that space, I think that thing. The last thing on the hedge fund side, Tim, I'll hit you, and then we'll quickly do a couple of questions on recruiting and sort of wrap is the AI thing. You brought up AI, so I want to kind of hit two things just on AI. One is the reason for why you kind of mentioned with the market the way it is, right, or where we are. There's obviously this outsized impact to public funds, public firms, but over time, I think as the AI private companies grow and grow, there's going to be certain winners in that space, and they'll kind of become the new public funds and stuff. So maybe talk to us a little bit about, you obviously spend a lot of time in technology. Again, it doesn't have to be where we are in AI today, because people will listen to this podcast today and they'll listen to it a year from now, right? So kind of just underlying, what are you finding super interesting in sort of that broader AI space? And maybe on the AI, the second kind of sub point there is, how does AI affect trading? Because a lot of the views in the market, right, is about this sort of alpha decay. The minute something comes out, 100, AI traders or, quant traders or high frequency traders or you guys have already picked it up. So where's really the alpha that's sort of going to be generated? You can take whichever one you want, but maybe talk to us a little bit about the AI tech industry that brought you into public investing to begin with, and why that's fascinating to you, and where that's, where again, not specifically, but generally, where that's going in your mind. And then number two, how AI is actually impacting day-to-day careers, professional life, and all that, especially in the trading space.
I absolutely love this topic. Happy to talk about it. Well, number one, me being interested in AI actually has somewhat of a heritage background to it. I was born and raised in Taipei, Taiwan. My mom is in the technology sector, and Taiwan, as you know, is super known for their semiconductor industry, which exploded along with AI as well. Big company there's obviously TSM. You got Foxconn as well. But Taiwan is a super small island, but it has an outsized kind of influence in the semiconductor value chain, which is obviously rising tide is lifting all boats for everything AI. So super proud to be a part of Taiwan and part of that growth. And that's part of the reason why I'm a bit, like I'm a bit more deeper into the industry, sort of understanding the supply chain from international perspective. And as a result, having more of a penchant to go towards it. And the second thing is, I think it's just a FOMO. It really just is. I think there are only generational opportunities for you to participate in something. We did not get to participate in the internet boom, and frankly, my generation did not get to participate in the LBO boom that happened in the early 2000s, stretching all the way until 2010s. We also didn't participate in the multi-manager hedge fund boom, that Steve Cohen was a part of. So, if anything, we need to be grabbing onto this, and at the very least, be somewhat of a domain expert in something that you choose in AI. I'm not saying I'm a domain expert. I'm far, far, far from one. But just in terms of general framework, I think, just as you talked about, the general framework for AI development is three layers. Number one, the first layer is obviously infrastructure and storage, compute. So this would be, companies that are number one selling the chips like NVIDIA, AMD, and then companies that are building data centers, such as the hyperscalers, and then companies that are renting out the compute for other companies to run, their models on. So that's sort of the first, and that the value there accrues currently, and this is what's happening now because that's the first wave. Value are accruing to the Google, Microsoft, Amazon, and NVIDIA, AMDs of the world, so the chip makers, and also the infrastructure providers. And then the next layer of this would be the model providers. So this would be, the startups of the world that are creating the bleeding edge models, or the super big hyperscalers who also have models like Gemini, such as Gemini, and then you've got startups that are creating, really, really specific and good models like Claude, Sonnet for coding, or general purpose models like Perplexity, and there are Chinese models too, DeepSeek, that tend to be more open source. And within China as well, you just got two, companies that IPO that are doing, one is doing consumer AI, called Minimax, another one is called Zipu, that does more enterprise side. And by the time that someone is listening to this in a year time, Anthropic and OpenAI is probably IPO'd by that time next year, which is a super exciting time for everyone to witness. And that's a second layer. And I'll revisit and talk about what the moat of each of these layers is and commoditization of that and what that means going forward. And then the third layer is, working off of the foundational models that we have, which will be quite a few of them, and each of them will either be general purpose or having some type of specific function, will be the more specific applications that come along with it. So, some of the talks that we've had about the application would be agentic commerce, for example. So Amazon having Rufus, a shopping agent where you're like, okay, I have foot fungus, and I want the best anti-foot fungus cream out there. Compare these couple ones for me, and then make me the purchase, right? So compared to traditional search and discovery, where you go on Google, search it up, and maybe there's some paid ads out there. The paid ad is now embedded into the recommendation of these LLMs, right? So as advertisers, this changes all of the industry structure of advertising, of purchase intent, of where customers are putting their eyeballs on. Previously, it was on social media. Previously, it was on Google, but now it's on LLM. So at the end of the day, there are a lot of big questions that come along with this. Number one, if you're an LM that recommended you to buy a certain, brand of anti-fungus foot cream, is it actually the best one? Are you making money from that recommendation? And also, are you being truly, truly objective, knowing that there's commercial intent behind it, right? So there's a user kind of reliability, involved in that. So that's sort of on the agentic sort of a commerce side. So we talked about these three layers. I want to talk a little bit about kind of the moat that gets created. I would say the application layer has the weakest moat. Everyone can hook on to an LLM, can hook onto a blend of ChatGPT, Gemini, or Claude, and create some kind of product for it, right? Some kind of personal AI assistant. The second layer, which is model provider, LLMs, this is going to be commoditized, but I would give them like a medium-sized moat because it's really hard to be creating training a model and then deploying it afterwards for some kind of purpose. But at the end of the day, a Gemini and their capability will be commoditized. The LM providers will be commoditized. They will all look basically the same. They will all work magically. I would say where there's the most moat is actually in the real asset side of things, in the infrastructure side, where you have actual R&D, proprietary R&D capabilities to create 2 nanometer chips that run, with so much more power efficiency than your competitor that no one else can catch up anymore. And you have a proprietary relationship with TSM to be able to ramp up capacity immediately within each quarter when orders come in. There's just so much kind of competitive advantage and moat that's embedded in the infrastructure provider and scale advantage as well. Not many people can spend $100 billion per year building out data centers like the hyperscalers, which is why this is distinctly different from the internet bubble. And I'll also make another point. A lot of people are talking about whether or not there's an AI bubble. It's a really big talk, and will continue to be a big talk going forward. And I would say the AI bubble actually matches with the 3 layers. And I would say in the incrementally in the infrastructure side, the very bottom layer, there's not really a bubble. But as you go up the chain, the bubble and the multiple starts increasing, right? Because it also just sort of goes towards the moat kind of idea. It's really kind of counterintuitive because as your moat increases, technically speaking, your multiple should also increase. But then what we're seeing is that as your moat decreases, your valuation actually increases. That's what a bubble kind of entails, right? If you look at the current revolution, it's all based on real assets, right? When you're spending something, you're spending $100 billion. You're actually buying $100 billion worth of real asset that will then generate maybe incremental return from it, right? This is something that's really distinctly different from sort of the internet bubble. And for model providers, model provider is a higher risk category. And how this manifests is ChatGPT has a $1 trillion, maybe potentially $1.5 trillion valuation, but they're only earning $20 billion in revenue. There's a real tangible business, business commercial problem they have to fix. They have to be able to generate enough revenue so that they grow into the 1.5 trillion. They can grow through ads, they can grow through agentic commerce, can grow through API calls, tokenization, whatever it is, but they just have to get there. And our job as investors to figure out at what point they're going to get there and if they can even get there even because right now what's happening is they're consistently losing share to Gemini every single week, and that's something that investors are watching. So I think going forward the next year, just for people who are interested, there are a couple of themes happening. I talked a little about agentic commerce being one that will proliferate. This year, the Black Friday season, people used Amazon's Rufus for 60% of all purchases. Well, at least that's what Amazon says. That's significantly better than first half. And people are using Rufus to compare products, summarize reviews, and then actually making a purchase decision. And then for the next year, I think autonomous vehicle is going to be so the intersection of physics AI is really going to come into play, with Waymo really deploying across the majority of states, with potentially Tesla robotaxi, rolling out without a driver, and Waymo's also going international to London and Tokyo as well. So those are two things to really watch from the consumer side.
Great points. And I think your focus on there's two focuses. One on the established players and who's kind of getting share. Just to add on, because Tim, you just did a phenomenal job of explaining everything. Just a couple of things. Only thing I add on is like there's a focus on the established players and who's kind of doing the incremental things to drive some of either work into their valuations or maybe justify expansion in that or potential contraction. And then there's the emerging guys who may not be public yet, but you're sort of trying to figure out if and when you might enter those areas and kind of what is their kind of moat going forward and really seeing where the market might be headed versus how much cash and capex and spend and all of that that's required. And then what are all the elements of that value chain that that are actually which are have a bigger moat than the others and so on. So I love that answer. I'm just gonna put a pin in that topic. The last questions I have for you are just take a perspective of a candidate either looking to enter the secondary space and the hedge fund. Let's start with secondaries. Just give us an overview of you having interviewed hundreds and hundreds of candidates who are looking to get into secondaries, and then obviously as a coach trained so many people going into secondaries. What is the interview process like, and maybe what are the 4 or 5 most important questions the candidate must be able to answer? If it's a case, kind of what type of case? Just give us a summary of what that recruiting process looks like, and I'm going to ask you the same question for the hedge fund side in a sec.
Yeah, 100%. Some of the questions that you should, absolutely get down, and this is not just, reading a guide and then sort of memorizing the stated response from that. It's actually like genuinely having conviction and genuinely having an interest in a strategy, and actually knowing what the strategy is. So, prep for questions such as why secondaries, right? What drew you to secondaries, and why do you think secondaries might be an exploding strategy or a not exploding strategy going forward? The same with that question is what are some of the drivers of industry returns or volume or deal volume in the sector? And the third is more of a mechanical question, like what are the transaction types? Like you need to be able to at least answer that there is minority recaps, single asset continuation vehicle, multi-asset continuation vehicle, perhaps some NAV financing, and maybe at the end you can add on employee buyouts, right? Employees tenders, employee secondaries. And fourth, know some of the characteristics of what makes a good secondary investment. We talked a little bit about them. All of the good private equity like characteristics all hold true for secondaries. Good cash flow, good revenue visibility, strong management team. Not a ton of not a high risk of default or over leverage, etc. But on top of that, having actually a substantiated view of how the GP does in context to the platform. And on top of that, being able to run that additional layer of fees on top of that and gaining conviction that you're going to be able to kind of make a return.
Amazing. And that was great. And then the first half of this podcast effectively answered all those questions, right? What is the secondary space? What do we do? What are the types of strategies? How do you look at, investments? Where do you drive returns? All that. So you've answered the question first and you've asked it. So similar on the hedge fund side, like maybe talk us through, obviously we have the most common one, right? Pitch a stock or pitch sort of a company, but even that one, maybe talk to us a little bit about what do you guys ask and what have you seen? What do successful candidates do? And then maybe you could supplement that with what successful candidates answer and kind of what should they do correct and what should they avoid doing. So just same exact question, most common questions, and what are we looking for on your side?
Yeah, for hedge fund interviews, it's actually a lot simpler than private equity. There's not a ton of paper LBO, like a lot of questions that they throw to like actually mess you up. For hedge funds, they're very simple. They only focus on two big things, and but very intensely. It is number one, what motivated you to join this firm? Or in general, what basically the read through to that question is what motivates you as a person? And the PM then can make the judgment of whether or not you're the right type of personality for this pod or for investing or for trading equities. And the second is your raw ability to analyze a stock. So this will come in the form of stock pitches. So usually for a hedge fund interview, it's very straightforward. Tell me about yourself. Tell me why you want to be here. And they might ask a few questions as to why you want to be here, make a transition. And then they'll go straight into talk to me about a stock that you like or not like. It's very simple. And compared to an investment banking job or private equity job where they value salesmanship, they value, your eloquence and your polishedness, the hedge fund world is the opposite. You don't have to sell. You cannot be selling because you have to be grounded in facts. And stock price moves not based on your optimistic idea that, what Jensen Huang said about, the sales order, like, it seems to be true, like it's super rosy, and you cannot be selling a business or making conjectures about stock reactions. Everything has to then come back to, all right, why is this actually happening? I have to see data driving this in order to believe that this is going to be real. So that's something that you have to be very careful of. A lot of, I think, investment banking and hedge fund, investment banking and private equity kids, they are using the same way of talking about investment and talking about businesses to talk in the hedge fund recruiting cycle. That cannot work. Everything that you say has to be substantiated by some type of data. And if you don't know something, simply say you don't know because they're, compared to the private space where, maybe you have a few participants playing in it, the public space is where there are technologists trading technology stocks, and there are biologists trading biomedical engineering stocks, right? And there are industrialists and double E engineers who are trading Jacobs engineering, who knows about the business and knows about the next product. So how do you, as a generalist who's maybe not double E, who's maybe not biomedical engineering, have an edge over some of those guys? I don't know. That's something just for you to go figure it out. If you can figure it out, you can make a lot of money. But that's sort of just the difference, between the two. And my personality is such that I like to learn a lot. I like to react to things. I like to stay super nimble, and I also like to have the thrill of having my thesis be realized or not realized, and know whether or not it's realized or not, in a shorter period of time, and then for me to recycle that, and then faster velocity kind of learning.
Amazing. Great. And last thing I'm gonna have you do, so for the next gen who's listening, for anyone, what is the kind of the best piece of advice you can give them, regardless if they're in banking, in PE, in the hedge fund space, or their MBA, or kind of corporate finance, or wherever they are. So just either the best advice you've gotten and you'd like to share, or having gone through the industry now for more than half a decade, like kind of what advice you'd want to share with those people that are listening.
I think I got two advice, pretty general. I think the first one is uh, focus on what you're doing. Um, don't focus on the next thing. I think a lot of people in this business, they, yes, they're ambitious. They want to plan out and engineer their careers. They want to get to the next thing that's better, the next private equity job, the next banking job, the next, hedge fund job. But they kind of fail to actually learn and absorb in their current job. There's a, sort of it's okay that you're recruiting. It's totally fine that you're going out there spending the time to recruit, but that should not be sort of the goal. The goal should be for you to learn as much as you can so that when you are recruiting, you are swinging really hard. And what that requires you to do is to really focus on what you're doing now. Not to ask the students to be complacent, but to really focus. If you have this job, maybe you're not 100% super aligned with it, no problem. Do as well of a job as you possibly can. Make really great impressions. Learn as much as you can in the job. So now you're not wasting time. And then when the opportunity presents itself, because you're so ready and so good at your job, you're going to be the first one to. You're going to be the first pick anyway. That's the first thing. I think the second thing is don't just do what everyone else is doing. You have to actually be able to take some risks. Um, and a lot of people coming out of especially the banking program because it's very structured, it feels really safe. I see a lot of people becoming incredibly confused coming out of the banking program because they don't know who they are anymore. They thought that their identity is tied to this professional, but they realize that they're not actually interested in it. So, I kind of came to that kind of point in my time at investment banking. And I'm one where I took a chance on my own career, saying, "Hey, I'm not going to go to all of these private equity firms doing exactly the same thing, running these like 2,000 line models. I can, but I really don't want to." And I actually took a pay cut to go work for something that, to me, I felt like I was adding a lot of value to the ecosystem. I felt like, in 20 years' time, when I look back, I can say bona fide, "Hey, I took a risk on my own career and joined a 5 to 7 people team." In an industry that was it basically when I joined and it exploded 200, 300% over the next 2 years that I worked there. Yes, there's this risk that this firm might have gone down or the strategy just really never exploded as expected. But that's sort of part of taking a risk, and I'm glad to have taken that risk as well. I'm also glad to have taken a risk of going into the public space as well. That's something that's a bit more opportunistic, and because the security of your job seat is less, a lot of people will kind of self-select out. But I'm also glad that I got to take this risk, and as a result, I'm learning about all of these things, with AI and bleeding edge development, et cetera, that I previously wouldn't have if I just maybe kept it more safe.
Amazing, Tim. I think just on those 2 points, and the first point on doing a good job where you are, I think for all the reasons Tim mentioned, from a learning perspective, from just living in the moment versus always living kind of for the future, that's very important. But that the point I'd add to that is that the world is very small, and so doing a good job in your current job actually has a lot of positive multiplier sort of compounding effects because that's going to be a reference for life. Those are the folks that are going to recommend you to different sort of jobs and all of this stuff. So I think there's a lot of another reason to do a good job where you are, and kind of stick it through is that the world is small and kind of we all have reputations and our reputations are kind of built over that. And the second point that Tim mentioned on taking a risk, and look, as someone who's seen over 100,000 people go to this industry in the last 5 years, I completely agree with Tim in the sense that the vast majority of people that are outlandishly more successful, and success is determined by three or four things. Number one, loving what you do. Number two, being extremely financially successful. Number three, getting things faster, right, in your career and getting to places. Maybe let's define those. And doing things obviously like you're passionate about. Maybe that's part of one. That's determined a lot more for people who, like Tim said, have followed. First of all, understood, introspected where they are, where their strengths are, where their interests are. Number two, followed and taken slightly more risk on pathways versus the same traditional PE funds. And I say that because I mean we also do recruiting and talent and pipeline and M&A for these top mega funds, and not that that's not a great job, but like over time you'll sort of feel like you're learning a lot more even via failure or even via going through smaller shop because you're just doing a lot more and you're just having to do a lot more things, and that forces you to learn a lot more and frankly get closer to what you really are meant to do and what you want to do over your career. So I could not agree with Tim more on both those points. And really, Tim, I want to just kind of step back a little bit. This has been sort of such an, and I love doing this one to, let everyone meet our amazing professionals and speakers and leaders and mentors and coaches and all this stuff. But number two, to cover really kind of black boxy concepts and make these industries more accessible for people, all the way from, a college student to kind of an experienced professional. Number three is to give Tim a platform to really connect and engage with large audiences and really teach and kind of deploy that sense. And so I think these type of environments, I love it. And Tim spent a lot of time with us today. I want to thank you for your generosity. I think, this is going to go out to thousands of people, and I think that they're going to really gain a lot from this. And hopefully, learn from Tim's experience, and because that's effectively what each generation and leadership looks like. And that's kind of what we're building here right on this platform is every generation kind of leading the next generation. And so Tim, I know we have spent a lot of time together. I want to really sincerely thank you. This went a little bit longer only because I was so interested in everything you were talking. You gave such in-depth answers to all of this stuff. But nevertheless, on behalf of the entirety of the platform, I want to thank Tim for your time and just insanely awesome insights on both the secondaries and private investing space, private equity space, as well as the hedge fund side. So thanks again for joining us and really appreciate it, Tim. Great job.
Thank you for having me, Kaushik. Thank you.
Anytime. Okay, Tim. I'll talk to you soon. Thanks, bud. Thanks, man. See you soon. Thank you.